Geneva, Zurich. It's been a busy old time. We're doing a new fund launch, which is why I was in Zurich and Geneva. So apologies, a couple of weeks have missed the weekly stock market update, but hey, you're all here now, and isn't that wonderful? So welcome. You should all be able to see me. I'm going to be at the bottom of the screen down here. As ever, let me know where you are, where you're from. And indeed, if it is your first time here as well, do let me know that too. It's always good to know, and good to see you all. Some familiar faces. Welcome one and all, including Peter from New Zealand. You're a regular. Jeffrey, my friend, you are as well. Malaga, 40 degrees. Well, it feels like London. Bedford, Shropshire, and Lincolnshire, London, of course, as well. Kavita, hello, Kavita. Kavita, I hope you don't mind me saying, both a DJ and a lawyer. Now, I'm going to get on with it. Jainesh as well, welcome from Gloucester. Right, let's talk about the market and navigating the stock market as it stands. So, oh, by the way, for this, you are definitely going to, because some of the slides you want to take a picture of, you're going to need your phone because you want to take photos of some of the slides. Not that I go quickly, but because there's a lot of information on some of them and there's little processes. So you will definitely, oh, Raj from Leeds as well. God's own country. Fantastic. Now, you should be able to hear me. Of course you can. Important information. It is the law that I can't give you individual financial advice for a very obvious reason. I'm not speaking to you individually, I'm speaking to you collectively, and I don't know your personal circumstances, and you're not clients. So there's a whole bunch of legal reasons. So this is for education. It is for information. Any stocks that I mention is not a solicitation for you to go and buy them or sell them or hold them for that matter. Anything that I happen to mention is given to illustrate the educational point. I may well tell you what I own. That doesn't mean you should go out and do it because your circumstances are definitely going to be different to mine. Okay, now, on the markets and politics, there used to be a column about 25 years ago on, I can't remember which website it was. I think it was on Merrill Lynch's that I did called Patel on the Markets. So I sort of brought it back. Let's talk about the politics and what's going on first before I get on to the rest of it. For those who are new to it, if you're wondering why there's a bunch of logos up there, for the last 20 years, I have a role with the Department for Business and Trade looking for outstanding companies. Those regulars, you'll know this. I used to be a director of the United Nations Association in the UK, and I lectured on behavioral finance at Oxford as a fellow there, and for Bloomberg TV 3 years. Chatham House, I was on the council for 6 years and the investment committee for 12 years, where we allocated our money, and our patron for all of that time was Her Majesty the Queen. And I used to work in the US Congress. So the point is, I'm taking all of that knowledge that I've taken from think tanks, from media, TV, government, academia, international relations, and giving you what my take is on what's happening on the markets. Okay, so you're going to start hearing the fear headlines now. Why? Well, because the market's at all-time highs. It's going up. So when we're at Bloomberg, we'd be thinking to ourselves, not how do we scare people, but how do we get lots of viewers? And if the market's at all-time highs, the obvious thing to do is to say, right, let's get some guests on who are bearish. There's no point saying when the market's all-time highs, hey, we're really positive on this. It looks wonderful. Let's all go out and have a picnic. You're going to say the opposite. Otherwise, how do you get viewers? It's just human psychology and obvious when you think about it. So you're going to see an increased number of fear headlines. Sometimes these become self-fulfilling. If you've got good quality companies, nothing to worry about. You look at the headlines and you laugh it off in the same way you might see, I don't know, sometimes you watch, I don't know, Twitter or something, and you see people saying awful things about you, or not about you specifically, about, I don't know, your football team. Leeds are rubbish. And you laugh it off and say, pah, what do you know? Same kind of thing with the markets. Don't get attached or married to it when they start criticizing the markets and basically your portfolio. Tesla. Now, I've said many times before, look, over the past few weeks, I have no doubt in 5 years it'll probably be double what it is now, but I don't want that volatility right. Now, this is an important lesson for people because people think investing is about picking stocks. It's not. It's actually about picking a portfolio. It's how everything meshed together. And it's also about the risk and volatility of the ride. The reason you want to make money is so you can be happy in your retirement, presumably. Well, if it's about happiness, then you need peace of mind. If you need peace of mind, you probably don't want Tesla, not least that it's dropped, 20% in a couple of days, despite the fact that I say to you, it might be up 100% in 5 years. So what? You think you can take that risk? Trust me, you can't. Why would you want to? It is crazy levels of risk you would be taking. So I would suggest to you, don't do it. Also on the political side, the big bill that's gone through Congress. Now, does that, as Musk thinks, mean the end of the US dollar, mean the end of US exceptionalism? Well, as some of you might know from my YouTube videos and TikTok posts, which I did last week when I did a recording, not a live webinar, but a recording of the weekly update, I was at JP Morgan Private Bank's lunch, where Howard Marks, who runs a $200 billion hedge fund, was speaking in a private room. There were about 200 of us in the room, probably controlling, I don't know, if you exclude JP Morgan, who'd flown in people from around the world for that, probably controlling about $1 trillion. Everybody else, $1 trillion, me, £5.50. But there were maybe not 200, maybe 150 of us in the room. And JP Morgan made it very clear what they're telling their clients, what the big money customers that they have, like $200 billion hedge funds, are telling their clients. US exceptionalism continues. The US dollar is not over. I mean, it's up to you. You could listen to JP Morgan Private Bank or some bloke on TikTok who says it's the end of the US dollar and you should all buy Bitcoin. I don't know. The guy on TikTok might be right, and there's a Hollywood movie to be made if he is or she is. But they were very clear on JP Morgan's views on that stuff. Now, if you want to watch the rest of it, it's on YouTube anyway, what I've done. And so I'm not going to repeat all of that. But certainly in terms of the big bill, there was no concern that was stated about Trump, tariffs, which just shows you that the president has now become irrelevant. Okay, so the newspapers discuss him. Wall Street couldn't care less. What the president now says, because of TACO, Trump always chickens out. His credibility is shot to pieces. He can say whatever he wants. He can impose whatever tariffs he wants. He can say what he wants about Tesla. It'll drop for a short while. Then everyone forgets about it. Everything goes back to normal. So that's one key thing which came out of that meeting. In terms of the big bill and increasing the budget deficit and tax cuts, that is fueling more supply of money into the economy and counteracting the impact of the tariffs. That's bullish for the stock market, just the way it is. And still, despite all of that, there's talk of cutting interest rates on top of it, which is all very bullish and positive. Would I have said that in February? No, in February, as it was falling and it looked like the end of the world and the president still had some potential credibility, it looked more like 2022 and a bit more worrying. Now we know, actually, we don't need to worry about that. As things stand, things could still change, obviously. But yeah, it was a lot more positive than I expected, and they were less cautious than I am, which is fine. Okay. And one of the key reasons for their positivity, which is the same as mine, is profits, earnings. Again, at Bloomberg TV, what we always used to keep an eye on is profits of companies. As I've said many times before, 3 reasons for a crash or stock market problems. And 3 types of companies you don't want, okay, for the same reason, because they're weak, they're rubbish. And those 3 reasons for a stock market crash are sourced from the 3 sets of accounts that a company has, which seems obvious when I say it. The profit and loss account, the balance sheet, or the cash flow statement. So what are the 3 causes of stock market crashes, and what are the 3 types of companies you don't want? First of all, the one which isn't making profits. That was the dot-com crash. Suddenly everybody realized, oh my God, this isn't making profits. Secondly, balance sheet problems. That was the financial crisis. Everybody realized, well, these houses aren't worth anything. So on our balance sheet, our assets, they're worthless. Companies, boom. Profitable companies with lots of cash flow go bust. Okay. And the third type of financial crisis is cash flow basis, COVID. You can't do business. Well, wait a minute, we're profitable. Doesn't matter. No cash coming in, you're going to go under. But we've got lots of assets. So what? You've got no cash coming through the door. You're going under. So essentially our way of investing, which is the Warren Buffett way of investing, which is the way that the academics who've done research on what moves stock markets and what the big banks do, is you really want to tick 3 boxes. Obviously, guess what the 3 boxes are? No guesses. P&L, i.e. profitable companies, balance sheet, assets, asset growth, preferably, P&L growth, cash flow box, ticked. Those are your 3 boxes based on the 3 accounts, and then a bit more, which I'll come on to a bit later. Very simple when you think about it, and pretty bloody obvious. That doesn't mean speculative gambling companies can't go up. Trump might do a tweet on something and it suddenly shoots up. In the same way, it doesn't mean that going to Vegas means you're guaranteed to lose money. But I'd rather just not gamble, thank you very much, when it's my pension. So that's where we are on that. Let's go into why we're at this webinar, okay? Or why anybody is at any webinar. Whilst there's no guarantee of improving, hopefully the education I give you might mean an improvement on your pension. It might happen in 1 year and every year, hopefully. Might get a 10% improvement on your returns every year. I'd be happy, you'd be happy. Might happen over 10 years. Once. You might just get a 10% improvement over 10 years. Thanks, Alpesh. All you did was add an extra 25,000 to my 250,000 pound portfolio. Not very good, are you? Might happen every year, in which case you'll go over the moon. So I put some numbers. That's why we're here. Now, I can't guarantee an improvement through my education any more than I can guarantee if you take soccer classes with me, you'll play for England. In fact, I guarantee you won't if you take soccer classes with me. But the point is, that's why we're here. And just a reminder, we're here, as David Kite said in my very first book that I wrote in 1997. I interviewed some of the world's leading traders, and one of them, David Kite, was a floor trader on the London International Financial Futures Exchange, and Financial Times published this book. David Kite said something to me which still sticks in my brain to this day after nearly 3 decades. And he said a very un-British thing, a very un-English thing. He was sitting behind his desk, and this guy's still in the rich list to this day. He had a desk at Cannon Street near the station, and there's a desk, there's a picture of the Queen, and there's a shredder. That's it. Desk, picture of the Queen, shredder. Nothing. I've described this in the book, and he said to me, "We're here to make money. We're here to make money." And it's the most un-English, un-British thing I've ever heard. You don't say things like that. I mean, we're not in America, for God's sake. Anyway, we're here to make money. That's why we're here. We're trying to, through education, get that improvement. Where am I on this? This is a really good one, if I say so myself, that I've created. Now, I suggest it's one of the ones you take a picture of and you print it out and you don't forget it, okay? Because it tells you the drawbacks of every single thing. Now, where am I at the moment? Now, February, March, I was here. Then April sort of moved along here. May got closer to this. And right now I'm about here. Okay. Just buying, easing into what I call my quality 5, which is about 37 companies. My wife and son are already in that portfolio. So half the money is in the quality 5 plus 37 odd companies. These are and I'll come to those in a second, drawbacks of each of these issues. You see, what people wrongly think investing is about is getting some stock tips and having a guy with the right degrees to produce a time machine to see into the future through his crystal ball. That's not what it's about. In hindsight, we'll know what the right thing was to do, but hindsight's bloody useless. And we're not going to gamble on what the future holds. What we're going to do is control the thing we can control, which is, well, what's our risk appetite, and let's make strategic decisions accordingly. So, like I said, I'm gradually moving over here. Wife and son were thrown into the boat of 50% of the money in the quality 5 plus about a month ago, and it's on the YouTube videos anyway. I think the last one that I did publicly, which was 3 weeks ago, or 4 weeks ago, is on there. Okay. Now, let's look at another way of looking at why we're here. And I'm going to come to the stocks and the stock market in a second, and individual stocks and what I own and what I've bought a little bit more of. But first of all, I want to take you back to something else. I get a lot of people emailing me, and it always shocks me. They've got this kind of growth. So let's say you've got 300,000, whether it's dollars or pounds, doesn't matter. Okay. After 10 years, if your return rate on your investments is that, and let's say you just compound annually, keep it simple. Okay. And you only make 5% per annum, which is what St. James's Place or your IFA or wealth manager will try and get you to do. Now, I've just deposited some corporate cash. We have corporate treasury. I use Flagstone, who open up bank accounts with different banks like HSBC and all the rest. I don't have to open up individual accounts. I didn't discover it. A client told me about it. And anyway, and I've just deposited some money, instant access at about 4.2%. Okay. So we're talking only a return slightly above bloody bank interest rates at the moment. And let's say you contribute not your full SIP allowance, but 40,000. You might not do that. Well, your end balance is that. Okay, that's how it fits up after 10 years. And you might say, well, I'm happy with that, Alpesh. You'll have earned 300,000. Basically, you'll have doubled your initial money after 10 years. Okay, and you might say, well, I'm happy with that. After 10 years, I'll have doubled it, sort of slow and steady. Most of it's come from contributions, which most people can't do basic math, so they think their wealth manager's an absolute bloody genius because they've got up to $1 million. Well, let's just have a look at that. Let's say you just did the market average. That's the US market average over the last 15 years, and that shocks people. Not me. I'm not telling you what I do. I'm just telling you what the market average is. Okay? So you start with that, you do that again, you do that, and you get this and all of this. Now you're up to 2 million. Let's just compare that from 1 million to 2 million. You've got twice as much. Okay? Actually 1.3% in. I sort of think of this as free money because my contributions are not free. Okay, they're blood, sweat, and tears. Equally, this is blood, sweat, and tears. This is the free bit. That's the free bit I've extracted from the market. Yeah, you'd obviously, everybody, they're not stupid, they'd be happier with this. That's the market average in the US over the last 15 years, right? Okay. So let's now go to, well, how much do you actually need? It's all very well saying this money, but how much do you need? Mikhail, I'll do an update on that as well. We have been playing around with AI and stuff, but I'll do a separate one for that. On the Telegram, we do updates every day, by the way. How much do you need? Well, one measure has been your annual spend times 25, whatever you want to spend in retirement. So how much do you need in retirement or whenever you just want to stop working, which I suppose is the definition of retirement. Okay, so I've done some numbers for you. Let's say you wanted $40,000 or pounds or whatever it is. Okay, you'd need $1 million. Now this is rough and ready. Okay, it's a rough and ready estimate based upon this, which is a common measure. Okay, and that scares people sometimes. I'm just telling you the numbers. All right, 80,000 per year you want to spend. Maybe you want to go on more holidays and all the rest of it. That's this. Now there's a danger with all of this. Remember, 2 to 4% inflation, rising life expectancy. It's getting older and older. They say somebody born after the year 2000 is expected to live to 100 years old. That'd be my son. He's 7. He's got 93 more years to live yet. And of course, potential healthcare costs. You might say, wait a minute, we've got the NHS. Yeah, but I think what you're seeing is more and more people doing more and more things privately as well. So this is very rough and ready. Okay. And your personal circumstances will obviously differ. I'd rather be cautious and say, let's assume we'll need more than we think, and so on. Anyway, so put another way is this, and that says euros, but it could be anything. If you want to do 30,000, you need 750. This is why I said you might want to take a picture. This is based on something called the 4% withdrawal rule, which some people are critical of. They say, no, it should be 2% withdrawal because of inflation, all the rest of it. Your needs might differ and so on. 100,000, 2.5. So there's different ways of measuring this. One is this, another is this. All I'm saying is you get a rough idea of the ballpark. You're never going to get it right to the nth decimal place, but you get an idea of ballpark numbers, rough and ready numbers. God knows what the future holds. Cost of living could go up, all sorts of things happen. More taxation could be impacted. Pensions could no longer be tax-free, in which case you're going to need a lot more money, aren't you? Okay, and so on and so forth. And that seems to be the direction of travel, that the money that's allowed to be put into a pension is going to decrease. The tax-free withdrawal amount is going to decrease. I mean, think about it. If you're chancellor, what would you do? Okay. You're obviously thinking, I need to get my hands on this money. Happens in third world countries, Latin American countries, periodically, Argentina, for instance, Eastern European countries. Just look at what they do with pensions. Gradually, the state nationalizes them. How does the state nationalize them? Well, it basically says, this is all going to belong to us now. Okay, and what does belong to us mean? It means higher taxation. Now, hopefully none of that will happen, but I don't know, you tell me. Every way there's ever been made to make money over the last 30 years, have governments not shut it, whichever color, have they not shut it down? Buying houses, buy-to-lets, pensions. I mean, if there is some other way, let me know. For me, that's why I particularly like foreign stocks, because they get their hands on it. Here's a little checklist. You can, again, take a picture of this for your pension. do this, and there's a little score thing at the bottom. I think I'll make this available at some point in a PDF on the Telegram channel later on. Okay, so I'll make sure I do it in due course. Put it another way, again, you might want to take a picture of this. Make sure you're aware of all of this, and if you're talking to your IFA or wealth manager, just ask them all of these things. You've got every single right to ask them and find out. Okay, so a few more things on the basics of what you should do before we go to the stock market as a whole, and let's have a look at that. In fact, you know what? I suggest you print it out and you shove it in your living room. It's that important. Now, where are we on the markets? So this is the markets from earlier in the year before I show you where we are now. And I did this image from earlier in the year to say, look, print it out. It's a good way of determining where we are and what to do. If you're at stage 1, you read this and you say, oh, okay, I can just keep holding. If you're at stage 2, you should get ready to maybe get out, okay, and so on. You can read this. Again, you might want to take a picture of this. And for a while, like here, we were at stage 4, which is this, okay? 4, what I call a daddy bear. Everyone tends to exit, as happened here, all right? And 3 is falling MC, risk averse are out, risk neutral exits, all or more on falls, risk loving holds. But 4, even the risk loving would, like me, would tend to exit. The danger is you get a V-shaped recovery and you end up buying back a bit more expensive than you sold. That's just the price of insurance of being out in case the falls were going to be sharper. Insurance policy of not having to suffer big falls is being out of the market and paying more to buy back in if it becomes a V-shaped recovery and the house doesn't burn down. My house hasn't burned down ever. Does that mean I'm an idiot having insurance? No. If next year I say to my wife, listen, we've never needed insurance, why should I bother paying it? What an idiot I am. She'd probably say, nah, I'd rather you pay the insurance, okay? So the insurance policy for people like me who are more risk neutral, or even when we're risk loving, is, yeah, we sort of get out if it looks like that scenario there, which is what happened in 2022. We get out, we stay out. And the danger is you end up buying back a bit more expensive. So what did happen? Where are we at the moment? Are we at 5? We're certainly not at 5 when I took this image, which was earlier in the year. We're not at 5. 5, by the way, is the important one. High or low on the weekly. The MACD is just a measure of short and medium term prices, average prices. Earliest possible entry for risk loving people. This is the S&P 500 largest US companies, and an index which measures their prices based on their size of those companies. So bigger the company, bigger the weighting on the index. High risk entry, might enter cautiously, small sizes, adding to winners. Okay, so 5 is what you're waiting for. 5, where the weekly starts moving up, is what you're waiting for. It's the earliest you'd possibly consider entering, particularly if you're risk loving. Okay, this is where we are bang up to date. 5 happened around there. That's the earliest you'd do it. I wouldn't want to get in that early, personally. I'd wait until I get a 6. What's a 6? You can take a picture of this. Rising monthly and weekly. I just wait a bit more, see a bit more. The danger of that is you're just waiting longer, okay? That's why son and wife were thrown into the lifeboat there. But me, I've only been edging in over the last couple of weeks, slowly into the quality 5 plus. My 37 odd stocks. I could have bought others, but just saying this. Okay, for that reason, because I really want that to be rising and that. Now you might say, well, I'm not interested in any of that. Forget it. It's all wumbo jumbo. I'm just going to stay in. Well, the danger with staying in is once every 7 years, you get this happening where it falls and it takes 2 years to recover. You might say, well, that's fine. 2 years goes like this and you make money afterwards. Yeah, except I'd rather be out during these falling periods and get in when it goes back up and have the gain in the second year. Excuse me while I drink some water. Okay, now I've got some questions. US dollar, would you buy your asset in dollars? I'd certainly be happy to buy US dollar assets right now because of the depreciation, which I don't think will last long. So I'll get a double whammy from sterling. So at the moment, buying US stocks, as I've been edging into the quality 5 plus, has had the added benefit. Now, The downside of everything that I've said is twofold. One is, you're having to watch this, which you might not want to do. Well, that's fine. Just buy and hold then forever, obviously. The other downside is, so you're still not missing out, so you don't have FOMO. Okay. The other downside is, as I said, you exit here and you end up buying back more expensive there. That's your insurance premium. Why did you pay that extra money, Alpesh? Why can't you pick tops and bottoms? Well, I can't pick tops and bottoms because I don't have a time machine or a crystal ball. Neither does anybody else, and all my degrees don't help me get producing a crystal ball. Trust me, I took my degree certificates and my master's in politics, economics, my degree in law, and I went to various people in the marketplace and said, can you build me a time machine with these degrees? And they said, no, you idiot. Okay, state the obvious. That insurance premium is the premium you pay for avoiding not only that and having peace of mind during that period, but also making sure it wasn't going to burn the house down. Simple. I don't have a problem with that. There are people who forever are trying to pick tops and bottoms. We call them in the industry, there's a technical name for those people. It's spelled FOOLS. Okay, so that's where we are, right? Now, where are we in terms of valuations? You see a lot of red and you see a lot of big names here. That's Microsoft, that's Apple, in case you don't know. It occurred to me recently, wait a minute, people might not know what the hell I'm talking about. That's Amazon, that's Tesla, Walmart, Costco, Coca-Cola, Visa, JP Morgan, Bank of America, American Express, MasterCard, Berkshire Hathaway, Warren Buffett's company, Eli Lilly, so I'll just name a few in case people don't know, Merck, Johnson & Johnson, Alphabet or Google, Meta, who else have we got? ServiceNow, Salesforce, Uber, of course, Intel, Adobe, Broadcom, Qualcomm, Micron, Intel. Did I just not just say Intel? Sorry, that's Intel. That's Intuit. This is Intuit. This is Intel. NXP Semiconductor, and so on and so forth. NVIDIA. I don't know why I've got this throat problem. Netflix, Disney. Okay. Over there, Verizon, T-Mobile. Over here, which has been a rather good company. So, forgive me for my throat. Oh, by the way, Philip Morris. Now, why am I mentioning all of these? What this is saying is you're paying $32 for every future dollar of profit in Microsoft. Think of it as buying a property. You buy a property. If I said to you, you've got to pay me $32 for this property, and you say, well, it makes $1 in rent a year. I said, well, I'm paying $32 and I only make $1 in rent a year. Okay, let me have a look at the next door neighbor, Mr. Nvidia's home. Well, I only have to pay him $26 and I get $1 in rent every year. That's cheaper. So valuation isn't the only thing. That was a measure of valuation, which moves stock prices. Growth is another thing. As well. But one thing I can tell you is that having a lower number than that suggests to me that NVIDIA is cheap or Microsoft expensive. Okay. Alphabet looks really cheap, both relative to its own history and relative to the likes of NVIDIA and Microsoft. That doesn't mean NVIDIA and Microsoft, that doesn't mean Alphabet's going to go up, because these could fall equally, but in absolute terms, that's unusual. There's Tesla. Tesla doesn't just make cars. They make the future. But I don't want it because it's just too volatile at the moment. Year 2 from now, when he's been deported back to South Africa, Elon Musk, which is what Donald Trump is now discussing openly, then it might be a different story. Apple, 26. Palantir, a bit expensive, but it's been doing well. Oracle. So we're going to go through some of these. Fortinet. We'll go through some of these companies and how they look, but valuation isn't the only thing that moves stock prices, is the point I want to make, and this is how they sit and stand at the moment. Now, through all the falls, one of the things I did, as you will know if you follow my broadcast, is I kept hold of Goldman Sachs and JP Morgan. I said, well, I want to prove to you, you don't have to try and get in and out on what I call a daddy bear. You could just hold through it, as we did with JP Morgan and Goldman Sachs, and it's worked out fine anyway, and I continue holding them. By the way, in terms of earnings calendar next Monday, by the way, this is my birthday month, ExxonMobil are the only ones who've got earnings, and that's not going to move the market All right. So where are we in terms of the S&P 500 so far this year? It's only up 5.6%. And these are the companies in the various sectors and how they're doing. Now, JP Morgan Private Bank at their their lunch, I'm from Yorkshire, so we call lunch dinner. At their lunch, said industrials continue looking good and they're positive on this. But put that to one side. The S&P is really composed of, its measure is really measured by these big bubbles because it's a market capitalization index. And these are moving up. That is going to move up and it's yet to do it. And that's going to move up and it's yet to do it. That alone tells me that that is going to go higher by the looks of it, because we can now ignore everything the president says. When we couldn't ignore everything the president said, it really looked like it was going to bring a crash. Although you're going to get some scary headlines, which will make things move lower in the near term. JP Morgan thinks S&P 500, 7,000 within 12 months. Okay, it's currently at 6,000, just so you know. That's their private bank in a private closed dinner, lunch. Can't take boy out of Yorkshire. That to me is cheap. Just in these numbers alone, that to me is cheap. And this is unusual. That to me is cheap. Okay. Where are we on a few other things? Almost in random order. India is the India ETF. I've been focusing on this ever since I was out in India, and just to show people, as with the S&P 500, the same chart I showed you with that can be applied to exchange traded funds, because funds are a basket of stocks. So their average prices tend to move more smoothly because they're a basket of stocks, not single stocks. So they tend to be less volatile. For that reason, the same analysis I applied to the S&P 500, where I showed you 1, 2, 3, 4, 5, 6 can be applied here. And at the moment, this is definitely one where it's early enough to enter on that alone. You might disagree with the fundamentals, so be it. I was in Zurich and Geneva for the launch of our India fund, which is a private equity and a public equity fund for institutions only. And you might say, well, you're clever. Fourth largest economy in the world, fastest growing major fastest growing major economy in the world. And you're saying, yeah, should be all right, mate. Yeah, that's what we do. Finance is not about trying to do low probability, hard work. It's about doing high probability, easy work. Don't take my word for it. Warren Buffett became the second richest man in the world by saying exactly the same bloody thing over and over again, but people wouldn't listen. Okay. Apple, where are we on that? Well, although it's one of the quality 5 plus 37 odd stocks, and therefore wife and son are in it, and I've been edging in. If it wasn't part of that portfolio, because that portfolio is not individual stocks, then I wouldn't be getting in yet because of that fall. But longer term, I have no issues with it. Love it, in fact. Now, here's something I want to show you. This is the return histogram based on its historical price moves. Now, past is no guarantee of the future, so this might stop working as of tonight, all right? But historically, this is how it's worked. Now, let me tell you why people would mess it up. How come the whole world just doesn't buy Apple 5 years ago, 10 years ago, when the Greek financial crisis was at its height? I said on the BBC, and I'm going to pull up the broadcast at some point. It's on the internet. And I said, the Greek government should just use German bailout money to buy Apple. And I said, in 5 years, their deficit will be gone. It was correct. Okay. So how come everybody doesn't do it? 2 reasons. The same reason I could tell you anything and you won't listen, or you'll mess it up. Panic and boredom. Okay. Panic and boredom is why private investors mess up their investments. Okay. Roger and everyone else, I will answer all those questions at the end, but thank you for putting up there. Keep putting the questions up. Donald, you're wrong, but I'll answer that at the end about Mandeep. Everyone, thank you for all of these. I will answer all of these as we go through the webinar. So, panic and boredom. What do I mean by panic and boredom? Well, if after 5 days, a low probability, which makes it even more scary, event like a 24% drop happens, you are going to panic. Okay? Then you wait 20 days because you get loads of grit and you get a bit drunk and you're still down 22%. 50 days goes by. Okay, so if the panic hasn't hit you in 20 days, i.e. short time frame, low probability event, big fall, that's what panic is in anything in life. Short time frame, i.e. happens suddenly, big loss, low probability. Whatever it is, that's when you panic in life. Things that happen slowly, nobody ever panics with something slowly, okay? Boredom sets in if after 24 days you're still down 24%. You're not going, bloody hell, you're not going to recover. Of course, that's what stops you getting to the 250 days and getting a half decent return. That's what, Paul, I'll come to that as well. Good question, Nova Nordisk as well. Thank you for the question. That's what stops you. Okay. Now, why is Warren Buffett a genius? Well, he says something very simple. He says, my holding period is forever. Well, if your holding period is forever, guess what? You can never be bored because you just said it's forever. And you can't panic because you just said it's forever. Genius. The problem is this. You need companies which have this kind of pattern. That's Apple. Do you know how many companies there are out of 10,000 stocks that can go in your SIP and ISA? UK listed, European listed that can go in your SIP and ISA, and US listed that can go in your SIP and ISA. Do you know how many have that kind of a pattern where they don't drop more than 10% over 250 days? How many do you think? Put it in the chat box. How many do you think out of 10,000 have that, where basically, for the statisticians amongst you, have a skewness to the right, okay, and have a small tail there, which isn't fat. Of course, in reality, tails tend to be fatter. How many do you think? 30, said KP. 50, Malcolm. Fair guess. Go lower. Go lower. And guess what? It's worth our time, energy, and effort to have researched that. You know why? Because we're here to make money. Better believe we bloody researched it. I'll tell you the answer in Martin, 100? But sorry, by lower, I don't mean higher number. I mean less than 30. Less than 10%? Yeah, it's less than 10%. Raj, 5, getting close. Raj is the closest. Friend from Leeds is the closest. Where in Leeds are you from, by the way, Raj? Past week, this is how the markets. I'm going to come to the answer in a second. Don't worry, I won't hold you in suspense. There's a poll I meant to do as well. And let's publish this poll, and I'll come to the chat in just a second. Okay. This is the past week and how it's looked. A lot of green, fairly good. A week is noise. In the short term, the markets are irrational. The most hilarious thing that I find, well, it's hilarious, is people try to understand the markets in the short term. So they might say, oh, the earnings are really strong. How come the market fell? So we do this at Bloomberg. And literally, and I've written about it in my books, my time at Bloomberg, and I'd say, they would write the article, and then if the stock was down, they'd go, well, it was down because the earnings were really poor. And then by the end of the day, they would literally rewrite and delete the same articles. You couldn't find the old one. And if the stock had gone up, they go, well, earnings were really positive, and the markets looked at it positively. I mean, that's how fickle the industry is. In other words, in the short term, it's bullshit. It's just irrational. Longer term, of course, it's dependent on profits, all the things that we care about. As long as humans care about profits and money, markets will be run by money in the long term. In the short term, it's speculation, greed, fear, supply. God knows what it could be. Somebody gets out of the bed the wrong way. If you really want to know, think about it. Who moves those prices? Well, back in the day, it was floor traders, literally on the trading floor, trading places doing all of this. So you'd think, why don't I ask some of the biggest floor traders what made them move the prices each day in a certain direction? So I did. I thought, well, if I do that, why don't I publish it? So the Financial Times published it. And David Kite, who Paresh used to work for, told me how they decide. And I published it in the book. Of course, who the hell reads Financial Times books? No one. They're all busy reading fiction or watching Netflix. Do you know what he said? What he said? He said, look at those newspapers on the floor. This is 1997. He goes, do you think any of my traders, because they're Barrow boys, none of them went to university, do you think any of them read the Financial Times? What do you notice about those newspapers? I said, they're red tops. Red tops are like Daily Mirror and The Sun. He goes, which is the most popular newspaper on the floor there? I said, The Sun. That's how they decide. I'm not going to go into details. It's printed in the book. It's published there. His exact words. He didn't care. When you're that rich, you don't care. That's how they decided which direction to go in. It's that irrational. And I got it straight from the horse's mouth. And he's still in the rich list, one of the best regarded traders in the world. They were just trading on momentum and how the men felt. And it was men. They want the market to go that day. And they just pushed it higher. It's all well documented. Okay, so that's the past week. More importantly, year-to-date performance, okay, that had quite a bit of catching up to from last year. Be positive on it throughout. NVIDIA, I've listened to a lot of, during London Tech Week and hosted for the UK government, a few events where I've spoken to AI people from different countries, different organizations, including the head of Cisco in the UK. And every time I ask them, I say, look, is this NVIDIA thing overblown? You know, is it bullshit? Is the Chinese going to just invent something and overtake it? Is there something we just do not know? And not one of them has said anything other than, no, that's the real deal. Okay, just like I could say to you, AI is amazing, and you'd go, yeah, well, thanks, mate, we know that. Or I could say to you, you know, this internet thing, it's the real deal. Okay, that's what we're getting at. I'm just looking to see if there's some kind of Achilles heel. Was it the Chinese or something? And I haven't found it yet. So the numbers is what I look at. They still speak for themselves on there. Meta year to date, Alphabet, they go through cycles, and that cycle is definitely going to end up going upwards. Okay, so you can see some of the numbers. I'll go through some of these. Yes, that's been good that I held through it. And similarly for JP Morgan, of course, in hindsight, I should have just had JP Morgan, Goldman Sachs, and all my money in those and nothing else. Why faff around with exiting on Daddy Bears and all the rest of it? Just held on to those and nothing else. But there you go. You don't just buy one stock. I'll do separate webinars on exchange traded funds. And again, sorry, the answer, by the way, the answer, it's about 6 companies. So Raj, you pretty much got it spot on, which meet that Apple type of formula where it's under 10% over 12 months, historically, statistically likely to repeat itself. It's very few companies. So you can imagine if you've got a very high bar like a Warren Buffett, that's why he has so much cash. He goes, well, what am I going to put my money in? By the way, I'll show you his portfolio in a second. So exchange traded funds, I'll do this separately, okay? A separate webinar, but if you want to take a picture, feel free. I don't want to, we haven't got time to go through all of this on top of everything else, okay? Markets year to date, it's very unusual that the UK is leading. Almost never happened since the Second World War. By July, that the UK is ahead of the US. Very rare. Actually, in the last 100 years. Very rare. NASDAQ wasn't around 100 years ago, obviously, but the Dow was. Okay. Where are we over the past year? This is the past year returns. Now, what do you notice about the past year returns? Well, there were prolonged periods of 0% gains. So you can have your 14%, but there were 0% gains and there were steep falls. So that's your boredom and there's your panic. Okay. Now, that's it. That's investing in a nutshell. How do you avoid boredom and panic? We'll come to that when you create the portfolio. And in a second, I'll show you some model portfolios. Where are we on the US markets? Now, this is something I want you to note, which is very positive, and it's what came out of JP Morgan's event that I went to as well. Total market capitalization of the US is 64 trillion. The US economy is, the annual GDP is, I think, 30 trillion a year. Could somebody look that up for me, please, what the annual GDP of the US is? I think it's 32 trillion. I might be wrong. Market cap, stock prices, in other words, have gone up 14%, but profits have gone up 15%. That's the figure you want to look at. Again, when I was at Bloomberg TV, that's the thing I would say to people. If there aren't profits, then all you're making money on is momentum, which is fine. There are very many momentum-based hedge funds, but momentum isn't necessarily as safe as momentum plus profits, plus undervaluation, plus revenue growth. Okay, so this is good news. That is very good news. American companies are making a lot of profits, and that's the bit that nobody ever bothers reporting. Why are profits important? Well, we're humans, and profits are important to us. Simple as that. Okay, money's important. So profits, they're making those. Earnings means profits, by the way. Revenues means sales. Okay. No, Ross, that's not the Quality 5 Plus. You're a bit behind. There's 37 stocks in the Quality 5 Plus. If you're a client, let me know, because I'll show you where they are in the slide on the monthly PowerPoint. Price to earnings ratios. I don't look at sectors, but for those interested, you're paying $30 for a US stock on average, and the forecast growth is 14.6% by the analysts. I don't look at sectors. I don't gamble on sectors. I look at individual companies. And if they happen to be in one sector over another, so be it. Okay. Now, here we go. I tell the public belatedly compared to my private audience. So the private audience will already know that my wife and son are in for past month, back in, I should say, in the Quality 5 Plus, which is 37 odd companies, which includes that. I held onto that throughout the dip, as the public will know. Okay. But these, for me, myself, got into after getting out of because of the daddy bear scenario. So did I pay a premium, an insurance premium of buying back higher than lower for most of them? Yeah, but that was fine. Well, not Apple, because actually that's still cheaper than before the fall. So some of them covered the cost of some of the others, but that's the insurance which you're happy to pay. UK, worryingly, market cap goes up, but profits are falling. To just be warned. Okay, and that this number, keep this, still a lot more to go. I better speed it up. Actually, and on the polls, how many of you think the UK is going to be high by the year end? 62% think it's going to be higher. Great, fine, okay, excellent. 62% think it's going to be higher. Let's see what you think with the Dow. This is the UK over the past year. I'll do a separate webinar on UK alone. Okay, so you can take a picture of that if you wish. And these are some of the biggest rises. One of my clients has got this. He seems to like it. I occasionally pointed out whatever he wants, data on it. But anyway, FTSE 350, the biggest rises over the past month. Again, I'll do a separate one on just the UK. When we did a UK model portfolio of the best UK companies, the returns were just poor compared to the best US ones. And you might say, well, that's bloody obvious, mate. But occasionally people ask me, why do you focus on the US? I said, well, we tried the UK portfolio and we looked at the US one, and the US one performed roughly twice as well as the UK one. And then you go, actually, their indices do twice as well, roughly. So no wonder. Yeah, stating the obvious, but sometimes people miss the obvious. They're trying to make it more complex than they need to. That's the NASDAQ where we are at the moment. Look at that. Okay, seeming to rise up again. Doesn't mean it can't pull back. I don't know, but I'm not gambling on falls or whatever. I'm just gambling on nothing. I don't gamble. What I'm looking at is quality companies to hold them, unless I get that scenario, which is what scares me. That's the only thing that scares me, and that happens once every 7 years. That one, where it looked like it was happening there, I would rather get out here and then buy back a little bit more expensive there. It's not much more expensive, but it was an insurance premium well worth paying, because A, I got to sleep easy during that period, and B, in case it became this, I didn't have to worry anyway. Fine. So for a little bit of premium, i.e. buying a bit more expensive, I avoided sleepless nights and the danger of that. Well, that's why I pay car insurance and house insurance and health insurance. Shit, I forgot about that one. Health insurance. This one doesn't matter. It's the shorter term stuff. Where are we on the FTSE? Near all-time highs. It's trying to bubble along and push through. Will it do it? I honestly don't know whether it'll do it or not. I am concerned about corporate profitability. So UK is not really my thing because I make more money from the US. That's Amazon, which, as I've explained before, while some of these are overbought and they might keep doing this, over the long term, wife and son are in, and I've been edging in. And there's your Amazon profile. There's your panic. After 5 days, that's when you panic. Now you might say, hang on, surely that implies that if you get a drop of 14 days, you buy that dip. In companies like this, yes, if you've got the spare cash. Wait a minute, if it drops 20%, you definitely buy the dip. And if it drops 30%, you absolutely, yeah. So why didn't I do that in February? Well, because if it's what I call a daddy bear on the S&P, then it's time to not, because this happens. Okay, so as long as it's not doing this, you always buy the dip. As long as it's not doing this, you always buy the dip. Why? Because you know the dip is that, and you've just caught a bargain. 10 companies which are like that. The others are similar, but not quite. So what does Warren Buffett, Bill Gates, and everybody else hold? Buffett holds 26% of his portfolio in Apple. Okay. Goldman Sachs' largest individual stock holding, $3.3 trillion in Apple. To put that into some context, sorry, not the largest, near largest, they've got 3.7 trillion in Microsoft and only 394 billion in Nvidia, 2.2 trillion in Amazon, in Meta. That looks very similar to my portfolio, not because I've spoken to Goldman Sachs or given Goldman Sachs Wealth Management my funds, but it's just coincidence that it does. Okay, so where are we? Now, this is interesting. He's got this. I wouldn't get that yet, but hey, he's the great man, so what? And what Bill Gates has got, obviously he's got most of his money in there. Now, I want to show something interesting to you on this. If you look at his top 5 holdings, right, he's got the bulk of his money. Look, after, what is that? 1, 2, 3, 4, 5, 6. Sorry, after his 6th largest holding, he's got less than 5% in anything else. Same with Bill Gates. After his 5th largest holding, 1, 2, 3, 4, 5, he's got less than 5% of his money in anything else. In other words, bulk of his money is risked on a few eggs. Put all your eggs in one basket, watch the basket, as Warren Buffett famously said. So I can fly in the house. Let's look at some of the biggest investing lies. They'll tell you it's about stock picking. No, it's about quality companies not panicking and not getting bored. Another lie, you need a master's degree from Oxford. Nope. We're not trying to out-expert anyone or gamble on news or noise. As Warren Buffett said, an IQ above 120 is wasted in finance. Lie, IFAs, wealth managers won't rip you off. Well, they will. They'll give you poor growth, as you know. They'll pick from funds which have a narrow focus, like UK only or US only or Vietnamese or whatever, and spin that into, wow, you're diversified. No, they've got a narrow focus. You've got a bunch of narrow focus funds that they can pick from. They're going to produce poor returns. My secretary is a fund manager now. Her first job after leaving university was working for me for 2 years, and then she went into asset management. Anyone can learn this stuff. Inexperience. A lot of the fund managers are inexperienced. She was a secretary for 2 years and then became a portfolio manager. That's not experience. Okay, I mean, working for me for 2 years will give you 30 years worth of experience, I'm sure, is what you would tell your future employer. But and you got fees forever you got to pay. Another lie, fund managers outperform simple index tracking ETFs. They don't. Eugene Famer, Nobel Prize in Economics, 2016 or 2018. Nobody told me the US GDP figure. Hi, Alpesh, what are your thoughts on Circle Internet Group? I'll have a look a bit later. You've got the same name, Sushila, as my grandmother. One of my grandmothers. Now, what's the key? This is me 21 years ago banging on about the same stuff. Do the sums right. Forget such magazine headlines or now Motley Fool as 10 stocks you must buy now. Market success has next to nothing to do with the stocks you buy. It's about the portfolio, the money management, and the this is 2004 when I wrote that in the FT. Okay? We're not going to gamble on news. We don't have crystal balls. Primed. That's what we want. Is it quality? Value, growth, income, cash flow? I'll come to those, right? Not narratives and stories. This is what people don't understand. They think it's all about, I've got to pick the next breathless insight. Alpesh is clever. He's got a phone call with Donald Trump after this, and he'll tell us exactly what's on the Trump's mind, and we'll get the right stocks. Nope, it's not what we do. Insight, discipline, mind. I mean, I'd love to sell you that story, but it just wouldn't be true. Management, money, risk, drawdowns. That's why you don't have one stock. You want to see how much of the individual stock volatilities, and I'll show you that in a second, how you will look at that. You might possibly do 2 times average. For most people, that's not suitable. And duration, minimum 12 months, 3 to 5 years. What I've discovered with my clients is they prefer the 3 to 5 years than the 12-month period. Because in 12 months, they could have good companies. 12 months are up and they think, well, actually, I want to hold this for longer. It's a good company. And this is what I asked them to do. You can take a picture of that if you wish. I asked them, is it one of the model portfolios that we've created? If it is, then are the lines in other moves in line with historical moves? Yes, then no need to panic or be bored. No. Well, that's rare. You might want to explore about buying more if the moves are outsized. Okay. No, it's not a model portfolio. Then it must be one of the what we call performance companies or filtered approved list companies. Well, has it been 12 months? Has it fallen more than 25%? If not, nothing to worry about. Simple as that. Simple process. Processes are important because when panics happen, that's the problem. I want you to have a look at, I've got a campaign, which some of you might know, campaignforamillion.com to teach 1 million people how to be better investors. Ooh, that's me. I'm meeting Derek tomorrow. That's me. Campaign to teach 1 million people how to invest better. I'm not talking investments with their Royal Highnesses. I'm just about to, and you can't quite see it, off camera, introduce them to my wife, who now is working at the Office for Investment, which is the UK government, sort of, it's out of number 10, bringing billions into the UK, into investment into the UK. Anyway, so I'm just about to introduce them. Discipline process. This, again, take a picture. This is how we do it. I'm going to show you this in a second. Does the stock tick the value box, the growth box, the dividend income? Now, why is that important? And we use a spreadsheet to do it out of 10,000 companies. Why is that important? Because what fund managers do is they'll try and sell you, or IFAs will try and sell you a value fund or a growth fund or an income fund. Well, surely you want the one bit in the middle. Now, they don't do that because they've got so much capital, they can't just put it in a few companies. They'd end up taking those companies over. But you can. You've got an advantage that fund managers don't. You don't have to pick from a narrow group of companies. They can only pick based on value, growth, companies, income, or by geography, UK, US, and so on. You don't. You've got that. You can pick from anywhere, which is why Warren Buffett and Bill Gates win, because they've also do that. They don't give it to bloody IFAs and wealth managers. So we put all that in, value, growth, income. We put in the research from Nobel Prize winners, Daniel Kahneman, Eugene Fama, Richard Thaler. Read, watch anything by those three, and you will be cleverer for it. In fact, I'll add a fourth one who hasn't won the Nobel Prize in economics, but really should. Warren Buffett. Richard Thaler, Daniel Kahneman, Eugene Fama, F-A-M-A. Fama. Model portfolios you hold for 3 to 5 years. Optional market, comment weekly if you want to listen to it. And there's your model portfolio. And that's it. Simple. What are you trying to do with all of that? That's what you're trying to do. You're trying to get, don't forget, 15% is the market. He's just trying to get a bit higher than that. That's my son. He was born, he's 7 now. So he's already, my God, he's already up here. The funny thing is, when I first started doing these, it used to be down here. And I go, oh, he's over here. This is with his ISA. ISAs, there's limits to how much you can put in. But that's what we're trying to get him to be, further up this curve. So the idea is by the time he's 10 in 3 years, we'll be thinking, oh, okay, he's got quite a bit coming in just passively. That's the whole point of starting early and trying to get better. It didn't work out like this. It was like 2018, when he was born, was a rubbish year. And then 2020, 2021, the markets were great. 2021, the markets were great. 2022, it was cash. So it was like 2023 and 2024, the markets were just phenomenal. Hey, the boy's lucky. He just happened to be born during a period when the markets have just been absolutely phenomenal. Now, I'm going to show you something, and I've got to say this to you first. Past performance is not indicative of future results. This material is for educational purposes, does not constitute financial advice. Won't mention specific companies. I'm going to mention a few that I own, but the ones I'm mentioning to you is for educational purposes, not for you to go out and go buy them. Okay? When it comes to model portfolios, this is what we're playing with. It's as simple as that. Your returns are going to be between 10 to 30% for each type of portfolio. Now, you might say, well, who the hell wants a 10% portfolio? You're right. So we get rid of those. And we said, well, what's the point? We're not going to try and create something crap. It's like trying to create a crap car. And your volatility or risk, which is the percentage by which you miss that return on average each year, do you miss it by 15%? Do you miss it by 10%? Is these. Now, you're also going to say to yourself, well, there's no point getting a 15% return and a 25% volatility. That's a bit rubbish. So you get rid of some of these. Now, here's one that I want to aim for. It's my birthday coming up. If ever I get to that, I will get the Nobel Prize in economics, because that is pretty bloody rare. Well, actually, it's impossible. I don't think it can happen. Now, you might say it's not even worth the effort, though, Alpesh, because that's doubling in 2.31 years. And something more reasonable is doubling in 3.4 years. So it's only 1 year difference. You're right. It's not greed. It's just the academic curiosity of the possibility of doing it. And that's the market average. 4.62 years, the US market average. Anyway, okay. I just want to try and do that as an academic pursuit. So where are we on these model portfolios that we do for clients? So this one is the Quality 5 Plus, okay, which is the 37 odd stocks that we have from 2017. That's the annualized version, okay? Does that mean that'll happen in the future? No, it doesn't. That's pretty close. We're fine with it, okay? This is assuming even in 2022, you held it during the downturn, all right? Because that's what it looks like. 2018 wasn't a good year. It was actually a bad year, and 2022 was. Now, let's get something straight. Did we know 2023 was going to be a great year for the market? No, we didn't. By the way, the market was up. The NASDAQ was up about 40%, I think it was, in 2023. So this looks great, but only because the tailwind is there. Tailwinds and headwinds. Tailwind was there. 2024 is this. Now, if you get in and out at different times, you won't get these. Like this year, wife and son will be closer to that than I will. I'll be lower than that because I was happy to treat it like that. But if you just held on, most people don't, that's what would happen. Okay. Now, one of the important things you won't, I'm not suggesting you look at this, but just so you know what's beneath the iceberg is just all of this. Now, you don't need to worry about any of this. Okay. But what I'm saying is it is not about, oh, throw me some stock names, throw me some stock names. It is not about stock picking. It's about creating a portfolio. Portfolios are important. 29 trillion. I'm going to go with the nominal value. Okay, 29, 30. So I said 32. I overestimated it. It's a bit less than I thought on that. Let me just put the poll off. So you're all very bullish on the US as well, the vast majority of you. Okay. Let's have a look at your experience with IFAs and wealth managers. So don't worry about these numbers, but just so you know, for those who are interested, by the way, if I can get that to be high, I'm really happy. More importantly, if I can get this number, okay, to be above 1, I'm over the moon. Now, I don't assume this is going to happen again or continue to happen. Do you know what I assume? Half of it. But wait a minute, Alpesh, you're rubbish then, because half of it's just the market average. Yeah, guess what I tell my wife? Yeah, times are tough. I think we'll only get market average. It's what Warren Buffett tells his followers all the time as well. Market average, probably what we're going to get. You know why? Because if you get more than that, you're a genius, over the moon. You start spending as if you're going to get what you got in the past, and you've got a shed load of problems and sleepless nights coming your way. You spend as if you're going to get half of what you got in the past. You got a life of happiness. I didn't say that. John Maynard Keynes. He put it slightly differently, but it was the same thing. Now I'm going to say this bit again, because I'm going to mention some stocks. This is not for you to go out and buy them, what I might hold, okay, before I go into all the stocks. What a different, and the stocks that I've already mentioned, what a difference growth rate makes to 100,000 over 15 years. Now, if, and this is what wealth managers want to give you, they want to give you 5%. You must, wait a minute, why are they giving you 5%? How shit are they when the index goes up 15? Well, it's because they've got fees and they're crap. They know they're rubbish because they know they have to give from a UK fund or a Vietnamese fund or a Chinese fund. They've got a restricted number of stocks they can pick from. That's what happens. After 15 years, you've really, in real terms, hardly moved. 15% per annum looks at that. Don't even think about that. That's if you're lucky. We've been lucky. We've had a few really good years. That's not down to me. I didn't make the years good. The stock market made them good. That might never happen again. I'm going to assume it's never going to happen again. I'd be an idiot to assume otherwise, wouldn't I? Okay. Were it to continue as it has done, then I will consider myself having lived through one of the most fortuitous periods in my life. Fantastic. Who cares? But guess what? The point I'm making to you is, if you go for the market average, but spend as if you're going to get that, guess what? You're going to have 2 million in debt. That's how businesses fail. It's how wealthy people go bust. It's why rich people make stupid mistakes. Daniel Kahneman gave this as an example, the Nobel Prize winner in economics in 2000, 2001. Now, why am I so confident? Well, average positive return, 32%. 32% is the average return of this rolling 2-year period, and it's positive 88.5% of the time. So it's not me doing anything. I'm riding the coattails and just making profits off the back of other companies' returns. I'm not clever enough to have created a Microsoft and Apple, Amazon, Costco, Walmart, JP Morgan, Eli Lilly, Novo Nordisk, ServiceNow. I just ride their coattails. Okay, it's as simple as that. Right, so can stocks even do this? Now, this is why I've given this, because I'm going to name some stock. Can stocks even get even close to this? And we're not going for that. We're shooting for the stars so that if we do badly, we end up with 15%, which is the market average. We're just trying to get the market average, okay? Well, these are ones which, from 2013 to 2023, have delivered 64% per annum, 61% per annum. Yeah, per annum. 33. Okay, 36. By the way, I'm going to tell you some that I happen to own now. I'm not going to tell you the whole shebang. You'll have worked it out already. This, I don't want the volatility of that. I've never owned this. Yeah. Yeah. I wouldn't mind owning that. It's just that I can't buy everything. Okay. Yeah. Nope, I don't have it. I'm not saying it's bad. I just don't have it. Okay. And these are the key drivers if you're interested. Top stocks with over 30% per annum returns from 2015 to 2025. There you go. There they are. Okay. I'm not saying you go out and buy them by any means. I don't even, some of these I don't know. Okay. Anyway, are there stocks out there? Yeah. How many exist? Very, very few. Very, very few. So don't go for the 30s and the 40s. Whilst I might try and target it because that's my ambition. You know, for me, it's I need to win a 10th Wimbledon title. I have to try and win it. Even if I fail and only get 15%, I get knocked out in round 3. So what? But I've got to try and be good enough to get to the final. And if I exit in round 3, so be it. So if I get 15%, so be it. But 30, 40, which happened in 2023 and 2024, because the markets were good, not because I'm clever. I'm not anywhere near as clever as people might think I am. I just do some simple things over and over again. That's really the clever thing. Now, be careful when you go for these types of companies. Reversion to mean is real. Many of these stocks experience deep 50 to 70% drawdowns. Don't think that's a buy list. It really isn't. There's a reason I don't have many of those on there. 20-30% CAGR over a decade is often followed by multiple compression. In other words, multiple negative years, unless earnings growth keeps up. Okay, so be careful. What are the future ones? Well, you probably want filters like return up. So I use cash return on capital invested. The closest thing is probably that. Cash return on capital invested. You want revenues growing at over 25% per annum. You want gross margins over 70%. Inside ownership has some statistical relevance. I don't think it's that important, but we found that there is some elements of importance in there. And markets growing at 15% per annum, such as some of these, and that'll change. 10 years, I mean, Monster doesn't fit that profile at all. Well, AI, I mean. Okay. By the way, if you want to know now, because you might be thinking, why am I not sacking my financial advisor? This idea. So we get asked this a lot. Alpesh, I don't know how to sack my financial advisor. There's a letter. Okay, feel free to take a picture. And if your financial advisor is St. James's Place, there's a specific one to do it. Feel free to take a shot of that. I say this because on the poll, underperformance and lack of information education are the two main things. Well, you're not going to get education from an IFA because they have to sit a multiple choice test, which has a 60% pass rate, so just slightly above 50% rather, is the pass mark, and it's multiple choice. And 20% you get just from statistical chance because it's multiple bloody choice. Okay, so they've just got to find another 40% from the remaining, and you don't need a university degree to be an IFA. So, which worries me somewhat. So anyway, so you're not going to get education from them, not like this. Underperformance, okay, major problem. So anyway, there's the letter. Take a picture. Let me know how many of you want to sack your IFA, and you can blame me for it if and when you decide to do it. So moving on, That was 2024. Again, I can't take credit for it. And you might say, well, they're bloody obvious names. Yeah, my friend, in hindsight, these are just some of them. So that's not the whole lot. Because obviously some didn't make money out of our approved list. What? Yeah, everything doesn't go up even in a great year. That's why you don't just pick one stock. Otherwise, I would have said just buy this and we'd be up 515%. And you'd think, how did you know, you witchcraft? Obviously, we're not good enough to have just picked one stock. Otherwise, we would have picked that. We're not good enough just to pick stocks that go up. It's not what it's about. 2023, 80%, 12 months. That's not because we're clever. You might say, well, that's bloody obvious, mate. You get paid the big bucks for that stuff. Yeah, I have that. Okay. 2022, 0%. Got nothing. Made nothing. Just so you know. The markets were down 20%. We made nothing because we simply followed that pattern. We followed the rules. We followed the process. Were we right to? Yeah, in hindsight, we were right to. Did we know that at the time? Not in January, not in February, not in March, not in April. We're still unsure. Okay. Ton of free resources there. I'm going to answer some of your questions. Oh, by the way, this is an advert we're working on. This is not the final version, so please don't. It's a work in progress. Still stuck with 3% a year? You're not alone. Discover how thousands are moving. I can't say thousands. From high fee, low growth pension and taking back control. So our ad people have given the mock up. Typical SJP, after fees, portfolio, DIY portfolio mix, and then hours. So we're getting that all sorted out, and then getting some client reviews where we've got getting the exact numbers exactly correct. That's where we're going to. That's my ambition. St. James's Place is in the FTSE 100. I want to float my company and eventually get it onto the FTSE 100 as well. And I've spoken to London Stock Exchange, and I can float it sooner than I thought. I want to get venture capital investment first. My wife is global head of the venture capital unit in the UK government, so I'm very lucky in having good networks. I want to get venture capital investment first, and then remove SJP, because I just think that's a good target to remove. I think they're bloody awful. 13 funds, fail value test, 75 fall short on performance. So how are we going to do things different? Well, we're not going to manage your money. Just like Uber doesn't own cars and Airbnb doesn't own properties. You're going to manage your own money. We're going to give you the data and the know-how to do it and model portfolios to do it. Simple. Because these kind of headlines keep pissing me off. And you know what they've done, which is a nice little trick? They've said, oh, we've changed. We've sacked the old government. Now we've created new funds. But those new funds don't have any history. Yeah, give us your money because we've got no bad history. We just wiped it clean. Seriously, and they got away with it. That's me, 1999. 1999. Probably sell up their entire UK holdings and buy only US stocks. 26 years I've been saying it. Not because I thought the US is going to grow as much as it has or anything else like that, but because I had more to choose from, so it could make the filters tighter. It's as simple as that. It really is as simple as that, and that's what you're looking to do. So I'm going to answer your questions now. Are you edging into Google even though monthly MACD is falling? Alphabet, I can't remember what I said about Alphabet. I literally can't remember whether I was waiting or not. It won't make much difference in terms of timing. That's what helps me. It really is the simple stuff. If you want to see some reviews of how we do things, alpeshpatelreviews.com, and their videos, because we figured if we don't do videos, people just aren't going to believe it. Now, the next question you ask yourself is, yeah, but Alpesh, I've got an IFA. Can I really do this myself? Well, that's why SIPs and ISAs were invented, for you to be able to do it yourself. It might be Barclays, it might be Hargreaves Lansdown, Interactive Investor, Interactive Brokers. Have a look at them as well, particularly if you've got a company account. If you've got a corporate account, have a look at Interactive Brokers, for instance, okay, to open up your own SIP or ISA. So we thought, well, what can we do, people? How do we make this like something they've never seen before? We do all the donkey work by giving them all the data, giving them all the knowledge, giving them unlimited access to me, but not charging them ongoing fees based on their assets and management. Letting them use whichever broker they want, whichever money, wherever they want to hold their money, entirely up to them. We never even touch their capital. So they're always in control. Give them all the education, give them access so they can sleep easy at night. I take on people who want it all done for them. Most people don't, by the way, obviously. Most people say, no, I'll just learn, watch the webinar. So that's perfectly fine. But some of them say, actually, yeah, I'd like you to handhold me through it, give me the data, save me time, And that's great. Those who sign up are the ones who pay for all the free webinars in a way, a bit like private schools pay for state schools in a way. Give them all of this, give them the risk assessment, all of this. But most importantly, two main things: unlimited access to be, so they've always got the education, which is also online, but at the same time, give them all the data. That's what we do. And we look at it like this, like I said, well, if you get a 10% improvement, not per annum, just even if it's in 10 years, over 10 years, that's 25 grand. I mean, hopefully per annum, obviously. Can't guarantee it, cannot guarantee it, obviously. Legally can't guarantee it because I don't know if the world's going to end tomorrow. Those are the numbers. That's what we're aiming for. So if your portfolio value is there, obviously if it's here, it's more of a no-brainer. We've got 10% of our clients are here. I'd say 90% of our clients are 1 and 2. They're in these two. 90% are 1 and 2. 10% are 3 and 4 or more. Okay. If you do want to be part of that, that's where you go. If not, enjoy the free stuff. I love the free stuff. I'm going to send you more free stuff on the files in a second. I'm going to answer questions. Do you think Trump will survive the November review, and who will take over now Elon has gone to Mars? Do you mean the midterms? Will Trump survive the midterms? The presidency is for a fixed period. I don't think he's going to abdicate, as it were. Malcolm, taking off from Nice back to London, if you could share the MACD weekly, monthly and weekly setup, I'll tune into the recording when I land. I'll send you a recording of this. We just use the default values because I found, as I've written in one of my books, trying to change from the default values doesn't make a difference. Dominic, hi Alpesh, for filtering stocks, Crocs, Alpha, what do you look for data past single year, past 5 years, or something different? Past 1 year at least you want, but when you're looking at the historic data of a portfolio, you want to try and get how has that portfolio performed over the last 7 years at least. You've got to include 2018 and 2022, which were bad years. Okay, so it's not about an individual stock today and how it's done over the last 12 months. Think about it, how little data that is. It's about then looking at the whole portfolio, which includes that stock, and say 20 to 40 others, and how have they performed over the last 7 years. And that's the mistake people make. They say, oh, last 12 months, it's done really well. PayPal, I don't have a problem with, but if you've got it, hold it. If you haven't, wait. Verizon, is VZ Verizon? I can't remember. You were going to clarify UK investors can hold ETFs. Yes, Donald, UK investors can hold ETFs. I don't know who told you otherwise. They can't hold US ETFs, but they can hold ETFs which are listed on the London Stock Exchange, of which there are numerous ones. Okay, so that's not a problem at all. They can do that. I think you've been misinformed. It might be that your broker is not allowing you to do it, but certainly UK investors can hold exchange traded funds. You might want to change brokers. Like I said, have a look at Interactive Brokers. There are others. Okay. Right. Now, chat. Verizon. I've not looked at Verizon. Accenture's been a disappointment. It's an AI play, and they want to be consultants in AI, but there's other companies which are better, which is why I prefer the other ones we've got. I'll give you an example of what I mean. None of these fit my criteria because they need to be green across all of these. So if you look at all of this, you can see how Accenture might fall into this. It might be good, but just not good enough because it's not. You need to be green across the board. That's how we decide. You might say, well, I don't mind. I'll just pick something which is good enough. Well, when it falls, you won't be so happy. Okay, so I'm afraid with the individual stocks, Accenture doesn't make the cut at the moment from what I remember the last I looked at it. I usually into Google. I can't remember, but I think it'll be a problem. China's at 19. US is at 30. The UK is at about 3.4. Oh, sorry, UK is at 2.8. I think India's at 3.4. Japan's at 3.3. So America is miles ahead of anybody else. Okay. Hi, Alpesh, what are your thoughts on Circle Internet Group? I don't know them, I'm afraid. There's other stuff I want you to look at. If you want some free articles on investing, go to alpeshpatel.com/shares. See that bit, read these, all of these preview ones. Why pensions are losing your money? Can you manage your own pension? All the ones which say preview, all of these. Also how 2023 turned out. We've got one on how 2024 turned out as well. We've got a 2025 update as well. So have a look. Oh, and there's one in particular for women investors, because the numbers are a lot worse if you're a woman in your pension. For obvious reasons, you earn less money over your lifetime because you get paid less. Okay, so it's alpeshpatel.com/shares if you want to see it there. The other thing I want you to look at, which I think you might find useful, is alpeshpatel.com/links, because you'll find all of this there. All of this stuff you'll find over there. Okay. And I want to show you some other stuff as well. It's legal and general worth investing in now. What, the company? No. Well, for me, no, because why would I want low growth when I've got such great growth elsewhere? So no. Hi, Alpesh, double check. Quality 5 Plus. No, you've got some old stuff there, Ross. What are your thoughts on sector-based ETFs? Well, I think you're picking a very narrow group. I think you're gambling on the sectors. Why would you not just pick quality companies and make your own ETF? Remember, you can create your own ETF. An ETF will have about 100 stocks. Why do you want 100 stocks? 20 to 40 is more than enough. Novo Nordisk. Paul, I'll let you into a secret. Don't tell anyone. My clients will get pissed off when I say this. I've been edging into it. Okay. I thought you can't hold, so we've done that one. Hey, when is your IPO coming? Well, Brad, I've spoken to the London Stock Exchange. If you've been following me, you'll know this past 6 months. So we're edging ever closer. Okay, Roger. Hi, I've been looking into passive index tracker ETFs for a simple, regular, long-term investment. Stumbled across quality filtered passive index tracker ETFs, which have usual low tracker ETF fees. Reading the literature, I think these funds appear to automate a no-layer filters such as, would either a MSCI US quality or world quality index tracker be good on a passive S&P? The best and easiest thing you can do, Roger, with that is just go onto Google Finance or Yahoo Finance and compare the two. Okay, so compare the S&P with that. You can do a comparison and just see how they've both moved historically over the last, say, 10 years. Okay, and the probable conclusion you'll come to is you'll find the right mix between 0 to 100% of how much you want in each. So you might say 50-50 in each, or you might go 30-70 and so on. That's the quickest and easiest way, and it's how I would do it if the only choice I had was binary between the two of them. What else have we got in terms of questions? Alpesh, first time watching. Yep. If there's any questions I've missed, just ask them again. Give me 1 second as well. And if you've got any questions about the program, let me know as well. My LinkedIn is on the links, alpeshpatel.com/links. You'll find my LinkedIn here with, why is the stuff not coming on? Oh, slow. Okay, so I've got some long form articles there as well on my LinkedIn. That's all free. You'll see it. That's me speaking on cybersecurity, quantum, and AI, and so on. There's a whole bunch of things. 3.5 million views on YouTube. Speaking of which, there's my YouTube channel, which is all on my links. I'll send you the links thing as well, so you get a whole load of free education there as well. I do a ton of stuff for free. And what I want to do, and for those who want to join the program, and there is alpeshpatel.com/shares too. And if you've got a company, obviously VAT registered, then it's even easier for you. Let me see, where are we on the questions? Okay, give me a second. On the questions, MACD for IBM. Dominic's the wrong way to look at it. Why are you just looking at momentum? Then you're trading. So it's irrelevant what the MACD for it is. Mikhail, as I said, we are starting to use more and more AI on it, and we're on version 4. If you want a newer version, just email us. Raj, Alpesh, since you're edging into things like Microsoft, which looks overbought, what would you look out for that would make you stop or edge it more in? Raj, remember, for the quality 5 plus, it's not about whether it's overbought or not. The only time not to buy it is if it's in a daddy bear. It's not in a daddy bear. So I think you've misunderstood the rules or been confused by them. With the quality 5 plus, it's never whether or not it's overbought. It is overbought. And generally, the presumption with the quality 5 plus, the 37 stocks in it, is to buy more, okay, not less when it falls, unless there's a daddy bear. It's that simple. It's that simple. Buy more, even if it falls. Do you sleep at night? Peter, it does look really busy, doesn't it? On there is a whole bunch of stuff. Would you believe I have a team who, once I record stuff, it automatically goes into Google Drive, and the team upload it. But also, don't forget, when I do events like my speaking engagements, this was in Zurich. I think that was in Zurich. No, that's Scale Up Awards, which I was judging, or the one that I just did in the UK and all the rest of it. They all go up here. And so what actually happens is, it was 2 weeks ago. There's a few more that need updating. There's just a lot of content because I do a lot of stuff. Don't forget, my YouTube videos are not just me sitting at a computer like this. There's a lot of stuff where I'm doing my TED Talks, for instance, and they'll be done into snippets. I'll let you behind the scenes a bit there. Or I'm sitting at the garden. That is where I'm just, where's the TV ones? Anyway, there's a TV. Oh, there it is, the TV appearances. So the TV stuff as well. I mean, there's a lot of stuff there, which comes up. So a month ago, 3 months ago, and so on and so forth. And then a whole bunch of others from 2 weeks ago. So yeah, there should be things more recent than that, like 1 day ago. As well. Okay, so yeah. Oh, these are just from today. Some of these shorts. Anyway. Will it be like independent financial advisor? Will you manage my portfolio and guide me for entry and exit? No. Not an independent financial advisor. I don't manage your portfolio. I show you with the data and the knowledge how you manage your portfolio. Okay? Put you in control of how to do it. And it frustrates me that people still want to outsource to an IFA who's rubbish managing it because they're for some reason too afraid. Installments monthly. It's monthly for 24 months. Okay. And you've got it for life, i.e. access to me and all the data and everything else. Jainesh. So you hold your cash. You don't give it to. This is what worries me. People go, they've got their life savings. Go, will you manage it? Why do you want to give me your life savings? What the hell? You should have it in your account with your username, your password, your brokerage that you choose, and then you knowing why you've bought something, so you can explain it to your spouse and say, oh, it's undervalued, it's growing, it ticks all these boxes, and this is what these boxes mean, and this is what it looks like. So we create a model portfolio for each individual client based on what they select and say, this is how it's done historically, this is how it might do going forward based on its historic performance, and this fits in with your risk profile that you've said. So you can just then do it. I'm teaching you to drive, sitting next to you as a driving instructor. What you're saying is, will you be the chauffeur with my very expensive car, Alpesh? Your expensive car. So you're giving your car keys to me. And you might think it's very nice being driven around, but actually I'm in the front. Do you really want me in the front seat of driving your expensive car? No, you should be driving your expensive car with me sitting in the passenger seat. That's how it should be. So that's the way that we have it. I hold Brinker International. It'll be good for me. It's just dropped 26% out of hours and bounced straight back up. Has worked some time admin correction. Sean, I'd have to look into that. Feel free to email me. I'll look into it. Did you see that CNC dropped 39%? No, I didn't see that today. I'll have a look. CNC is not one which I'm familiar with. Stock. Centene. Oh, yeah, Centene, I know. I'll have a look at that. That might be a good opportunity to buy Centene because that looks overdone. Oh, healthcare. I suspect it's to do with Trump. So that looks like one which, if that goes from 33 back to its all-time highs of 93, then you're looking at tripling your money. I'm not saying, I've not had a detailed look yet. I'll have to have a detailed look. But when it's an outlier on the downside, which is historically a pretty good company, yeah, it looks like I can see a picture with Donald Trump and Centene. So that gives me an idea that it's to do with Trump panicking the market, which has been a good opportunity of late to buy stuff. Joseph, Alpesh bought 100 shares today. John, thanks, got to go. Peter, Janesh, Dominic, Raj. Okay, I'm going to go now. Somebody's written, please, KP, can you share the link in the chat? Oh, yes, sorry. www.alpeshpatel.com links. I'll share that, and I'm going to share. I've got to share a whole load of files with you as well. So let me share all of that stuff with you. I think you should be able to see a bunch of files now, which should have come up on your screen somewhere. Everyone else, you can email me afterwards. Correlation score, well, ideally, of course, you want it to be naught. Thank you, Kavita. Hope to meet you soon. The correlation score, ideally, want to be a 0 between all your assets. Good luck. Even JP Morgan Private Bank couldn't do that, and there was a lot of talk about it. And they said, well, if we go into European equities to try and look for non-correlated assets or Bitcoin, the correlations were so high. Here's the thing about correlation that people don't know. When the markets fall, everything's correlated to the downside. So it doesn't really help. Okay. Thanks, Mick. I hope you found it useful and educational. By the way, this is not a buy list by any means. It's showing you what isn't there. When and if I click June filtered, then you'd see all of the ones which are green. Out of 10,000, there's only 200 which appear there. And then for somebody, say like you, Janesh, you'd narrow that down from 200 down to about 40, suitable to your risk appetite. Your risk appetite in the portfolio is the key thing. It is not, oh, I just bought Arcadis or whatever. So none of these meet our profile at the moment. Ideally, you want correlation of 0 if you can get it. If you can get it, you won't get it. It's next to. I was asked about Legal and General. I don't know. Not for me. I don't think it's a good stock, Joanne. Legal and General for me. All investing is personal. It's not good for me. Okay, because I've got better other companies. So I'm afraid it's not good for me, but that doesn't mean it's not a good company for you. But I don't know it off the top of my head how it's doing. I'd have to look at the financials in far more detail on that. It's been, oh God, oh, it's for a long time now. It's been doing nothing. So I just couldn't tell you which way it's going to go from this. Might fall, might go up. I don't know. Okay, I'll be honest with you. When I don't know, I don't know. The thing people don't realize is I know about the 200 companies which meet all my filter and criteria. All the other ones that don't, I don't know. Why should I know about every single one? Again, people get it wrong what they think. It's like if you ask Warren Buffett, what do you think of Legal and General? Go, it don't meet my criteria. I've got my stocks in my portfolio, or the ones which are on my approved list and meet my approved list. Everything else is then gambling and speculating outside of it, I think, so I don't bother even looking at them. LinkedIn, all the links are on alpeshpatel.com/links, www.alpeshpatel.com/links, including my blog and everything else. It's on there. Here it is. So what you'll see on there is the webinar. It's this one you're on. You can get a 30-minute one-to-one tour of the software mentoring program, pension review, books, can download access to my LinkedIn, my daily market updates on your desktop or phone. And we include what we see from the major hedge funds and banks on there as well. And there's a whole bunch of other stuff on there. Okay, so that's where we are. Oops. And if you want to go there, feel free, and I will see. For those of you who signed up, I will email you after this webinar. If anybody wants me to reserve one place, I'm willing to reserve one place, but I'm not going to do more than that on this. And let me know. Okay, I will speak to anybody else soon, and you can always email me from there should you wish as well. If you need to email me, markers highlighted. There you go. There we go. Thanks, everyone. I will see you soon. Thank you all very much. Whoops.